Forex Clinic, where you get the solution to your trading challenges. If you are a newbie and you are struggling with so many terms, so many things about trading, don't worry. The Forex Clinic will diagnose your problem and provide a solution. And if you don't have any idea at all about trading, the Forex Clinic also will give you your starting point. So for example, those who are here live, many of them don't have any idea on trading. So it's their first time. And already hope is beginning to come alive in them that they will become traders. I've already told them before the end of this year, if they follow carefully everything that has been taught here, they should start doing 5 figures. They will build to that point. They will build to that point. So today we want to just dig deeper on what we have been building on. There's a secret I want to share with you about trading that most traders don't know. Only few profitable traders know about this. And what is that secret? Whatever is popular is being exploited by the liquidity provider. There was a time that when people were trading with trend line, they were making profits. Trend line with MACD, just trend line MACD, they were making profits. However, when that strategy was saturated, the use of those indicators, when it was saturated, liquidity providers started exploiting it, meaning that they will allow price to fail around that edge. So majority will lose. Do you understand? Majority will lose. Now, when it wasn't working was when they started coming with more indicators. People started building new indicators and new strategies. People started using moving average crossing. When it came, it was working because a lot of people are still struggling with trend line MACD. A few people have moved into moving average crossing. So the few people were making profits. When people migrated from trend line to moving average crossing, what happened again? Liquidity providers started exploiting it. When ICT came, it was the deal breaker. It was working perfectly. But right now, ICT is also being exploited because most people have moved to ICT. And now trend line is working again. Most people have moved to ICT. And now it's being exploited again. That's why if you see anybody who is profitable using ICT, he has an edge. There is something is adding to it. He has built an edge for himself that he understands the language. And that edge is what we have been talking about all the while, is the market structure. Under any regime, because there are different regimes in markets, markets will always print different kinds of structure depending on events that are prevalent. Under any regime, you will still see higher high, higher low, higher high, higher low, higher high. Under any regime, you will still see lower high, lower low, lower high, lower low. It doesn't matter the regime. That is why mastering the structure is very, very fundamental. This is not indicator trading. This is not moving average crossing. This is not overbought on RSI or oversold on RSI, this is what the market will always print for you. Either it's going up or it's going down or it's resting, sideways movement, where it will be just be doing as gold is presently doing right now. Right now, it's ranging. And once it is ranging, what do? You step aside. And when you are in a trade, let's say you pick a trade and your trade fails, if you understand structure and you pick a trade, your trade fails, it tells you something straight away. It tells you that market is changing direction or is ranging. If you understand structure, because if you understand structure, you will not trade against prevailing structure, prevailing trend. So if peradventure you are in a trade and it hits your stop loss, you should know straight away that it is either the price is pausing or it's a change of direction. Do we understand to that point? Do we get it to that point? So anytime, any day, this is what liquidity provider cannot exploit. Price will always print. It cannot just go without an impulsive movement and a pullback. Price cannot just go straight up. There must be a pause somewhere. And this pause you are seeing, it means two things. Number one, many things, but basically two. Number one, those who bought from here to here are taking profit. So when they are taking profit, the liquidity in the market reduces. Do you understand? I hope I'm not making too much of explanation. You can understand what I'm saying. Let's say there is $1 million here. From here, people have made profit up to this point. Now, from that $1 million, some people are pulling out $300,000. It won't have power to rise again. They are taking profits. That's why you are seeing that pullback. Number two is that liquidity providers, hedge funds, they want to absorb new order. They want to bring in more money. So, and the rule applies to everybody. That don't buy when it is expensive. Even when you go to market, you want to buy tomato, you are looking for the cheapest one. Am I correct? Somebody cannot be selling his own 1,000 naira. And you are hearing banjo, 100. Your ear will not go there. And you say you want to stick with 1,000. No. You will go and see. Number one, you are not just buying immediately. You want to see the quality. You want to know why this person is selling lower. Once all your reasons have been justified, you buy it. That's exactly what happens in trading. There is no gimmicks to this. It is not gambling. It is not try your luck. It is pure psychology, human behavior. That's why you have to take it as a real business. Even though it is a game of probability. But you have to approach it very seriously. You don't just go in there, go and gamble out and say, let me try buy, let me try sell. Everything must be defined. No one taught us this, oh, I'm telling you. Nobody taught us this. Some of us had to learn this thing by ourselves, by personal studies, personal diggings, working with liquidity provider, brokers, having insider information and what have you. Just like I explained to you yesterday, I don't know that there's anything called mock-up, where you are trading with your friend. Both of you are not trading the same thing. Even though you are trading the same assets, the price you are being given is different from the price that your friend is giving. Many things happen around this. However, once you have a better understanding, positioning, it becomes an edge for you to do well in the market. That's why some of us, we can still go into the market with $500, $200, $300. At the end of the week, we are coming up with 300%, 1,000%. And we do it again, again, and again, and again, and again, and again, and again. Repeatedly. Repeatedly. So let's go back to what we studied yesterday, and then we continue to build on it. So I'm going to ask us a question just to know whether we are following and we truly understand. We truly understand what's the concept. Basically, what we have been discussing since last week is the market behavior. Basically, so let me ask us a question. Remember, we have what we call our anchor time frame. Anchor time frame, which is always the higher time frame. It could be 4 hours, it could be 1 hour. You can make your own 30 minutes. You can even make your own 15 minutes if you want to do serious scalping. Now, if you are using any of this as your anchor time frame, your microstructure have to be lower. So let's say microstructure. Microstructure is the lower time frame. All right. If you are using 4 hours, maybe 15 minutes can be your microstructure. 5 minutes, even 2 minutes. Oliver Velez trade 2 minutes, then 1 minute. But if you are using, don't get confused. If you are using 15 minutes as your anchor time frame, you can't use 15 minutes as your microstructure. You have to switch to 1 minute. Because even if you move to 5 minutes, you might likely be seeing the same thing. Because there are just 3 candlesticks of 5 minutes in 1 15 minutes. Do we understand? So you have to switch to 15 minutes. So I will advise that for beginning, start with any of these 3. Then use this as your microstructure. Do we understand? I'm coming. Let me pull up the charts. So let me be seeing what is happening in the markets. I pick a buy this morning, and then hit my stop loss with return back to my entry. So immediately I knew that market was consolidating. If it were to be before, my frustration would have been very loud. Yes, because you'll be saying, it's like they are pursuing you. It's like they are waiting for you to enter the market. It's like these brokers are trading against you. You know, what you don't know, ignorance, will just be making you to say nonsense or to think nonsense. Look at the VWAP 2. The VWAP 2 is flat. The VWAP is flat. It's telling you that no trade. Okay, so now, when you see something like this on your micro time frame, Anu, what are you looking for? Higher high, higher low. So now, this is, what trend is this? Bullish. In a bullish trend, what are you looking for? Anu said sell. I'm even writing your name for people online to see. Anu said sell. Is anybody online? If you are live, if Anu is correct, tell us yes. If she's wrong, tell us no. Let me call Anu versus somebody else. David, this is a bullish trend. Are we selling or buying? David. So everyone who is correct, Anu or David? David is correct. Anu, you are wrong. Bullish trend, you look for buy. Bullish trend, you look for buy. Bullish trend, look for buy. Bullish trend, look for buy. Now, second question. We have HHHL, HHHL, HHHL. Farouk, what does HH means? What does HL means? So where do you buy? Are you buying at HH or HL? Sorry, I didn't hear you. Okay, so Farouk said buy at HH. Farouk. Oh, Ayomide. Shade, are we buying at HH or HL? Buy at HL. Shade. Everyone who is correct, Shade or Farouk? Shade is correct. You buy at HL. You buy at HL. You look for buy at HL. Never buy at II. The price is expensive. Don't buy. If you go to the market, you will always be looking for the cheaper one. If you want to go and buy clothes, you look for cheaper clothes. Even if it is a designer, you look for the one that is cheap among that brand. And you will always get, because individual retailer have their different price because of the profits they want to make, and because of some other factors that influence maybe where they got the goods from. Maybe they are even retailers of retailers. You know, there are some retailers that got from wholesalers. There are some retailers that got from retailers. That will influence the price because everybody wants to make money. So if you are buying at HH, it means you are buying expensive, and it's very dangerous. You buy when the price is cheap. Buy when the price is cheap. Buy when the price is cheap. Now, next question. You see this. You see HHHL, HHHL on the higher time frame. And then on your microstructure, you start seeing LHHH, LHHH. I'll correct it. So on the lower time frame, we start seeing LHLL, LHLL. Thank you so much. You are following. LHLL, LHLL. OJ, what does LH means? What does LL means? Lower low, good. Now, on the higher time frame, you see HHHL, HHHL on the same trade, but on the lower time frame, you are seeing LHLL. What is happening? What do you call what is happening? Downtrend. Bearish. Good. It's bearish. Now, on the higher time frame, is doing bullish. When it is now doing LHLL on a lower time frame, what is happening to the market from the view of higher time frame? Try. What you are looking at higher time frame, okay, is doing higher high, higher low, higher high, higher low. It has now done higher high. H. Now, when you now switch to your microstructure, it's now doing lower high, lower low, lower high, lower low. What is happening to the market from 1 hour, from the higher time frame perspective, from your anchor time frame perspective? What is happening to the market? Try. Samson, what is happening? He's doing it. Please let me clap for my wife. She didn't start the class with you. She don't be ahead of you. It is doing a pullback. It's retracing. Do you understand? I know you know it, but the name didn't come to you. You didn't understand the question, you didn't understand correctly. But now you understand what we are trying to say. So it's doing a pullback. Why? Because higher time frame has the bigger picture. Lower time frame is captured in the higher time frame. So when you see a trend in the lower time frame, it is still a baby of the higher. We said that you look for buy, correct, right? We look for buy on a higher time frame. When we start seeing lower low, lower high, lower low, lower high, yes, lower low, lower high, lower low, lower high on a lower time frame, what do you do? Anyone who gets this one? Anyone who get this one will pay me 5K. If you get it, I pay you 5K. If you miss it, you pay me 5K. Okay, so now, anyone who gets it, I pay him 5K. Anyone who miss it will pay me 5K. Do you agree? Do you agree? Let's go. On the higher time frame, is bullish. We are looking for buy. On a lower time frame, is bearish. So, thank God. You have said you are looking for sell. Let's know whether you pay me 5K today. Now, what are you supposed to do? Explain. That is the question. Yes. Explain. No, I didn't. I'm not. No chorus answer. No chorus answer. What are you supposed to do? This is what is happening on a higher time frame. Wait, let me go back again. Let me do it properly. Now, higher time frame is doing this. Lower time frame, your microstructure is doing this. I want to look for buy. What am I supposed to do? Explain. Oh yeah. Do you agree? If you miss it, you pay me 5K. If you get it, I pay you 5K. Do you agree? Do you agree? Do you agree? Do you agree? No, you pay me now. You are too confident. You are so confident of yourself, Emmanuel. Oh yeah, come and tell me.
Since we are playing a bullish anchor time frame, we are looking for a higher low on the anchor time frame. That means somewhere where the thing is going to get to here. Can I get it?
Yes, sir.
Somewhere where it's going to get to somewhere, something like this. And so this line that is happening here, what is actually happening here? So the first thing we're going to look for is our next lower high that is here is going to turn to a higher high first. So it's going to break here. Immediately breaks here, you already know that it's no more following the trend of lower high and lower low. So when we have to pick our next buy, is going to be something around here where it either equals to our previous lower low or it ends somewhere like before our previous lower low. That means it doesn't break our previous lower low. That's when we pick our next buy.
Are you done? Is it correct? Let's clap. Let's clap. That's.
You said when the anchor time frame and the level time are not aligned.
Yeah. So, and that was what happened. But immediately there is an alignment. So Emmanuel got it right. So I'm owing him 5K. Yeah. So make sure you share with your colleagues. So now, when you start seeing your anchor time frame, when you look at your anchor time frame and it's doing something, and then your microstructure is doing the opposite, you are waiting. It's actually giving you an insight that it is time. Get ready. Get ready. Now, you have to allow it to complete the opposite direction cycle. It will be as it's doing lower high, lower low, lower high, lower low. You are waiting because you are not supposed to trade against the direction. You are supposed to do the same thing. You know, you want to look for buy. Now, please pay attention. Now, your microstructure is doing opposite. What it is actually doing is a pullback to form a higher low. And you are supposed to find your entry at higher low. So while it is doing that pullback, you are waiting. You are waiting. So you are waiting for these things to happen. There are two ways it can happen. There are two ways. Watch. Number one, once it start dropping, the first option or the first way it can happen is that it can just form a lower low, and then the lower low breaks the previous lower high. This lower high here. Price breaks it. Second option is that while it is doing this, it forms the lower high, all right? Then it forms a low that is not lower than the previous low. Then it breaks the previous lower high. Do you see that they are not the same? Look at the board. They are not the same. One did a lower low. One did a lower low, then went straight to break the previous lower high. The second one did a lower high, but refused to go lower than the previous low. And then it broke the previous high, the previous lower high. Now, option 2. The second option, the entry is not the same as the first option. Pay attention. This is very tricky. This is very tricky. Option 2's entry is not the same as option 1. You see, option 2, you can actually enter immediately after a complete breakout. Here. Do you know why? Because of this. This is no longer a lower low. This is a higher low. The moment it breaks and the candlestick fully breaks above the lower high, you can enter. Immediately it breaks. Now, on the option 1, something is still not complete. If you look at option 1, something is not complete there. It did a lower low, then went straight to do a high. Do you know it can come back to do this and take out the previous low? So in this option, you can wait for it to come back without canceling the lower low. And then a break above the low it broke before. So you will now see something like this. Now, on the anchor time frame, pay attention to this. I hope you understand it to this point. Now, on the anchor time frame, this is what you will experience. When you look at, after you enter on the lower time frame, let's say you enter before checking, you will discover that you are entering somewhere here, not here. Even though you entered after a break of the lower high here. Do you understand? By the time you check your anchor time frame, you discover that your entry will be somewhere here, not here. So why the market begin to play out in your direction, your TP1 can now be the previous high. Price gets here, you take some, then you go higher, TP2 and more. Then your stop loss will be below the previous low, not candlestick, behind the low. Why? Because if the price fails, it tells you that your entry was too early, or you still want to pull back more. Or it could be that you want to even change direction completely. And it is permitted in trading. Nothing is perfect. Or it want to range. So your entry will now be entry, stop loss. So if it comes back to break, you will see that it will take out this one, it will take out this one. And then that's a change of direction. This thing is very simple. So now, having understood this structure, you now had some other indicators to it to give you more confirmation of your entry, What will first give you an insight to entry is structure, not indicator. Write that down. What will give me the first insight or by entry is is structure, not indicators. Some people use indicator to find somebody is coming from the town to this place, and he has gone to stop at Palm Grove. There's 1212 in Palm Grove, but that 212 is Ikorodu Road. Ours is 212 Lagos Road. When you are coming from town to the office, it is Ikorodu Road. When you are leaving Ikorodu to Lagos, it is Lagos Road. Hey, sorry. Kindly send me the link. Let me send it to somebody. Let me send it to him. Okay, so now, remember what I just said. Some traders will be using indicator to define their setup. You are using structure to define your setup, but you are using indicator for extra confirmation. What did I call it yesterday? Who can remember? Confluence. Confluence. That means it's a meeting point where two or more rivers gather together. They call it confluence. At least if I didn't remember anything in geography, I remember that one. So others use indicators. That's why you have an hedge. You are using structure. Structure doesn't change. It is the same anytime, any day. So you only use indicator to fine-tune structure. Who can tell me why I box those areas I box? Why did I box it? I don't want Kuros answer now. I don't want Kuros answer. I will call somebody to explain to me so that everybody, at least if the person doesn't know it from his explanation, then somebody else can explain. So no chorus answer, please. Why did I mark that box? David, why did I mark that box? Okay, it's ranging. Key area, okay. What is the correct language there? What am I waiting to happen? No, there is a language they use in trading for it. I know, try. I know. What do they call it? Yes, sir. No. What do they call it? What am I waiting for? What do they call it in trading? Breakout, breakout, breakout. Why? Because if you see that price has been moving within this area I just marked. Price has been moving within this area I marked. So price must fully break out of this zone before I now begin to think of what to do. So if it break lower, what am I going to see before I begin to consider sell? Let's say I want to consider sell. What will I see? Apart from the fact that it will close below this area, what will I see? Simple question. Yes, Dominion. Okay, which is what? And lower highs. Simple. Lower low, lower high. If it breaks up to, I will wait for higher high, higher low. It's better. Yes. It's better. Because this is anchor time frame. Sorry, this is microstructure. Microstructure. So it's better you allow that structure to fully form, because it can break out and then return and do what they call a fake breakout. That's why completing that structure is very good. I don't want you to become an aggressive trader. Yes, I don't want you to be an aggressive trader. Always wait. But execution is at microstructure. You have time. You have time, so you have to wait for everything to form. So now let's start introducing our indicators. Structure first, indicators follow. Structure first, not indicators first. Structure first, then indicators follow. Wow, there's a coca even around that 212 that is saw at Pangrove, Coca Estate. So send me the link. Let me forward it to him. Okay, thank you, sir. No, not YouTube link, address. So there are many indicators that people use. I will just teach you the one that are commonly used and the one I use. All of them are saying the same thing, depending on how it is being used. The ones I use, though there is one I don't really use again, but I will teach you them. I will teach you. I use moving average. It has been my friend since I met Jason Sen. Simple moving average, because there are two types. There is exponential, there is simple. I use Fibonacci retracement. Fibonacci. I've not really been using it for some time since I learned structure. So I don't really use it again, but I will teach you. Then I use VWAP. VWAP has been my friend recently. Why? Because it helps me. I don't need to mark other block. The area where you will see your VWAP, there is another block there. That's why I use VWAP. VWAP means volume weighted average price. Then once in a while, I just look at RSI, relative strength index. There are some other ones so with funny names. Let me look for their names and tell you some of their names. There is Ishimoku Kinkun Yong. There is Ishimoku Kinkun Yong. There is Parabolic SAR. I met somebody recently who is using this zigzag. There is bear power, bull power. So, stochastics. I've used that stochastics before. I've used it before, but I left it. Then I've used divergence. Yes. Okay, that one is chart pattern, not indicator. Once you understand structure, you don't need those things. For example, people can call this one double top. Hem pattern. But once you understand structure, you don't need those ones. Double top, triple top, bullish flag, bull flag, bear flag. Go and bring down my mat on my table. You see one mat on my table. Yeah, you see some of them, many chart patterns here. Hold it for me. Yeah, you can see. See that double bottom, inverted head and shoulder, falling wedge, double top, the one we just mentioned now. Head and shoulder, rising wedge, many of them like that. Bullish flag pattern, many. You don't need all of this. Maybe for just knowledge sake. Just the structure alone is enough. Once you understand bullish trend, bearish trend, higher high, higher low, when it forms, when it fails, reversal. Those failure is what is forming those things. Do you understand? Those failures is what is forming those things we are seeing. So let's look at, in the next 20 minutes, the indicator we can talk about, how to use them. VWAP, very simple. VWAP just tell you that anywhere I am, that's where order is being built. That's where order is being built. I am at the location of a demand zone in a bullish trend. I am at the location of your supply zone in a bearish trend. Anywhere I am, that's where institutional traders are building orders. If price is above me, if I'm bullish and price is above me, that means there's a continuation of the bullish trend. So for me, my bias is changing already. I'm seeing a bullish structure forming already. So I'm seeing it buying back here. Sir? Yes, you can even enter aggressively, but I said I don't want you to become an aggressive trader. Yeah. So you can enter strongly here, but don't be an aggressive trader. If it closes above that place, just wait. Price will always come to you. We have 21 days, 24 hours in a day. So price will always give you something to take home. It will always give you something. So VWAP is saying the ideal place to trade is where I am. Once you have that breakout, allow price to retrace back to my area, then you can enter. Will price always come to VWAP? No. And then it will continue. So if you say, for all my trade, I will always wait for price to get to VWAP, you might miss some trade. And if you are going to be very conservative, it's good to mistrade that your entry is very solid. But if you want to say, no, I don't want to be missing too many trades, then you will not rely only on VWAP. You have to introduce some other indicators that can be used. Yes. Yes, sir.
If, for example,
Not automatically. It's telling you that we are still in control, even though on a higher time frame we are bullish.
what shows
Yes, who is in control? Exactly. Exactly. It shows us who is in control. And even the VWAP is still flat right now. It's not yet showing sign that I want to go up. So let's introduce moving average. That's how VWAP is being used. It's just a location, an ideal location where others are. So if there's a breakout and then price comes back to VWAP, you can go in. Or price breaks below the VWAP and then pull back. Now, this is what I'm saying. We are bullish. We are looking for a buy. This is the VWAP. Then suddenly price comes, break below it, and then break back into it. Considering this one, taking out this one, it's telling you that it has done what they call liquidity sweep. It breaks below it and comes back above it. It's telling you that, yes, it's a good place to enter. And then your stop loss is below it. That's how VWAP is being used. Yes. Yes. The same thing if you are selling. The same thing if you are selling. Then let's look at moving average. I know that they will not allow us to use the two together. Now look at moving average too. Look at the moving average. The rule is when the market is flat, is sideways, moving average is useless. That's why they are also telling you that right now we are not working. When price is ranging, they too become flat. The moment the asset begins to trend upward, you will see the moving average too. They will start showing that upward momentum. They will start also going this way. So now this is how you use moving average. Let's say price has done lower low, and then we are waiting for a confirmation. All right. Now you will see that one of the moving average moves closer. Once a bounce is around that moving average, it's telling you that price is using that moving average as a support. Most of the time, I use my moving average as support. And it works very well. In fact, many a time, price will get to moving average and just reverse. Many a time, most of the time, price gets on the moving average and then begin to bounce. Look at example here. This example here. Price came back there, stopped, and went up. And you will see many more like that. Price using the moving average as support and resistance. See, bounced from it, and then look at that downtrend. It went up very far away from the moving average. Then it started coming down, coming down. The moment it got to the moving average, it started bouncing. But don't forget, structure first. Structure first before entry. Even if it bounces on it and you have not seen structure being formed, don't enter yet. For example, look at this one. Lower low, lower high. He had to cross the 50, then came to the 100. Then broke the lower high somewhere here around the 50 before price climb higher back to this zone. Do you understand what I just showed you now? Is it getting confused? You are getting confused. Right. Okay. Let's do it this way. Forget whether we have 200 or whatever. Let's say you are using only 50. You can choose anyone you want. You can choose 50. You can choose 100. You are not using it to initiate trade. You are only using it to add to a structure that has been formed. Do you understand? And you are saying if price comes around it and does not break below, it's giving me more confirmation to come in. So I'm using it as a further proof or validation that the decision I'm about to take now is a good decision. Once price is above it, it tells you that the momentum is bullish. Once price is below it, it's telling you don't buy. Do you understand? When price is above it, it's telling you you can look for buy, don't sell. Once price is below it, it's telling you don't look for buy, look for sell. Does that make sense? That's how the moving average is used. So I think what confuses was because I put so many of them. So you are now like, which one am I going to use? Which one is it? They are looking different. You can just pick one. It's because I have mastered how to use the 3. In fact, I use 20 more effectively than even the 50. But when most veteran traders, they don't talk about 20 because 20 is too fast. Yeah, it goes faster. When the momentum starts picking, it peaks immediately. 50, 100, 200, they take time. They are not price, they are days. Yeah, days. 200 days. So it's telling you what has happened, what is the price, the moving average of the price for the past 200 days. The average of the movement. If it's just to support, is to support your buyers. If price is still below it, and then there's a break of structure that we spoke about, you below my moving average. Let me wait for price to come above it. The moment price is above it, I can find my entry. Do we get that? And if it is confusing, you can decide to leave it and just use your simple RSI. Or near 30, it is oversold. Do you remember? When price is near 70 or above 70, it is overbought. It's very falling. It is overbought. So, let's say you want to buy. You are looking for a buy, and price is still around 70. you might still have to wait a little. Now, this is how the RSI is. 70. I think this place is 50. Then 30. Look at this region is oversold. This region, are you following? Is overbought. So, I am looking for a buy. This is my anchor time frame. Let's pay attention. This is my anchor time frame. Now, my structure, microstructure is doing like this. And I'm looking for a buy. Remember, we are looking for a break of structure, a change of character. The moment you see this, and then on RSI, it start doing like, it get to this point, it's telling you you can buy. But if it's doing this thing and it's still somewhere here, it's telling you it's overbought, it's still overbought. Don't buy yet. Or most of the time, you will see that by the time it's going down, RSI is following it. Do we understand that? RSI is always following it. The moment price starts dropping, RSI to start dropping. Particularly, and it drops faster, particularly on the micro structure. It drops faster. So check your RSI on the microstructure, then check your RSI on the anchor time frame. If the anchor time frame is that telling you maybe price has not come to around 50, yes, you can buy. On the lower time frame, you will see it somewhere here. On the anchor time frame, you will see somewhere here. If the market is very strong in momentum, like very, very, very strong, you will just see it hanging around overbought. But if it is very strong in momentum, you can continue. Because the stronger the momentum, the more price don't do strong pullback. When market is in a very serious, strong momentum, you don't see pullbacks anyhow. Then finally, Fibonacci. Let's look at how Fibonacci looks like. Fibonacci does not work at all, when market is flat. It doesn't work at all when market is flat. You can only use Fibonacci in a trending market. And how do you use Fibonacci? Yes, sir. Sir? Ranging. Yes. This is Fibonacci retracement. Look at it here. It's been long I used it. So now, you go to your anchor time frame. That's where you use your Fibonacci. You go to your anchor time frame. You pick the recent low and the recent high. This is the low. This is the high. You know, we are looking for buy somewhere here. So we will use Fibonacci. So somebody come and tell us where is the recent low and the recent high. Somebody come and show us the recent low and the recent high. People are afraid. Kagbo kékeré má ṣe bẹ̀rù. No, on the entire chart, come and show me a low and a high. Oh yeah, now.
Just
Recent low, recent high, yes. From there, from here down here. Come and show me higher high, higher low, higher low, higher high, higher low. Yeah, it's correct. So let's pick this one. Let's assume that this is our current higher high. And then this is our low, for example. Now, you use your Fibonacci retracements. This one is very, let me remove all those. I want to remove the color.
Go down.
Okay. Come and set it for me. I just need 50, 20, 30, 50, 60. Just 20, 30, 50, and 60. Yeah, I think that's it now. No, leave it like, leave the value. Okay, I think I've set it now. Okay.
Is where you.
The way I arrange it. Okay, now everybody look up. That's how they use Fibonacci retracement. They consider the high and the low, and then they want price to come into those areas, those percentage, 0.2, 0.3, 0.5, 0.61. They have different name for it. The 50 is called equilibrium. That means price drop 50%. The 60 is called discount. It did more than 50%. Then there is 20, there is 30. Now, if you look at this particular trade now, price just came to the 0.2, to the 20%, and then take off from there. Now, those who are using Fibonacci retracement, they don't use it alone. They combine it with other indicators like moving average. Because using Fibonacci alone, it will make you to miss many trades. Many people consider that the ideal place to wait for price to come into is either the equilibrium or the discount. Price should drop back. But in this case, look at it. Price didn't come to 50 and 60 before moving up. So once they put it like that, they can now add, let's say, the moving average to it. And remember the rule of the moving average. Once price is not below it, it's not bearish. So the moment price retraced, it came on the 20, then touched the 0.2. Some traders will pick their trade from here and buy. But those who have been taught to wait for price to come to 50 or 60, they will miss this trade because price didn't come into their zone. That's why there are a lot of participants in the trade with different view of the markets. different view. If their edge always give them advantage, they will keep to it, even though it fails once in a while. Do you understand? For example, let's say out of 10 trades, I'm always waiting for price to come to the 50. Out of 10 trades, 5 always come to the 50, and it gives me profit. They don't change it. They remain like that. They stick to it like that. So the days that price gets to 20 and then continue, they don't force trade, they leave it. They go and look for another one. Do we understand? No, you guys are not following me anymore. Do you understand what I've just explained now? You know, I'm a teacher, so I know when my students are stuck. even though if they are pretending and they are saying they understand, I know they don't understand. Okay, finally, Fibonacci retracement. Different people use it in different ways. Do you understand that one? Do you understand that one? Yes. Good. There are different points, percentage of the Fibonacci. There is 20%, 0.2, the red one. There is 35%, 0.38, the yellow one. It's automatic. You are not the one typing it there. Once you go to Fibonacci, it will come out. There is 0.5, 50%. That 50% is the one I call equilibrium. What that means is price retraced back. Price pulled back 50%. Do you understand? Why the 0.6 is the 60% or 65% or whatever figure it is? That one is the one they call discount. So different traders approach it differently. Some traders will say, I prefer price to come to 50. That's why every one of you, I will not want you to be trading the same thing. I'll be trading the same way. You have to practice your own unique method with the foundation we have laid. Some will say, I prefer the 20. Some will say, I prefer the 35. Some will say, I can use I prefer 50. Some will say, I want price to come to 60. So what they are saying is, if price gets to 20 and it bounces, I will leave the trade to go. If price comes to 35 and it bounces, I will leave the trade to go. If price comes to 50, that is where I want to pick my trade from. Then they will now add it with other indicator. Do you understand? They will add it with another indicator, combine the two together, because no indicator must be traded in isolation. Don't use RSI alone in isolation. Don't use moving average alone in isolation, because all these indicators are lagging indicators, except for Fibonacci. Fibonacci is not lagging. It's a tool that is telling you what is happening right now. If price comes to 50, it's happening right now. But Fibonacci doesn't work when market is flat. Do you understand? And this Fibonacci, the concept is that in a human body, there is Fibonacci in us. In human anatomy, there is Fibonacci. That when a man begins to grow, there's a level it will get to, and then it will have what they call a pullback. And that decline could be 20%, it could be 30%, it could be 50% before it grows again. Because I actually went to find out what is the genesis of this Fibonacci. I did a lot of study in Forex. So A lot of studies. And I discovered that it's a mathematical concept using human anatomy. Do you understand? And can you see, if you look at the Fibonacci we just drew here, see how price aligns. It came to the 20 and bounced. Another level is the 30. It can also come there, bounced. How they are able to arrive at this is not anything magical. It's a mathematical concept. So, and whereas there are some traders who will use all of them, whether price get to 20, 30, 50, 60, anyone I can use, provided that it also aligns with other indicators. My mentor Jesse said uses the smaller level set. In fact, if price go below 20 and 30, he doesn't trade it. He doesn't trade it. He uses 20 and 30 with his moving average, but he doesn't use 20. His moving average starts from 50. 50, 100, 200, 500. So once price comes to 20 or 30, and then it meets moving average 50, just pick it. In fact, he doesn't even trade instant execution. He plays pending order. Once he draws Fibonacci, he sees moving average around there. You just place a buy stop and a buy limit there. When price comes there, you already have a set stop loss. Using structure as a stop loss. Okay, price must not break below this low. Let your stop be below this low. And then he gives TP1, TP2, TP3. So that's how Fibonacci is being used. You can now begin to change the tools as you want it, as you understand. If you don't understand Fibonacci, leave it. All right? It's not compulsory to use. It's been long I used it. It's been long. I'm not sure I opened Fibonacci throughout last year. So I'm fine with my VWAP and my moving average. Mostly my moving average. That's why you will see 4 moving average on my chart. Always, you will see the 4 of them. 20, 50, 100, 500. You will see them. So we'll continue tomorrow. Any question? Any question? Yes, sir. Real account is the same. The only difference is spread. When you start trading live, spread and commission. In demo, no spread, no commission, nothing. Yes, when you are trading live, there's now emotion. No, nothing is different. That's why if you are going to be a successful trader, once these things are correct, you will always make profit. Number 1, your trend bias, trend direction. Once you get this trend direction, you understand direction very well. Then number 2, you use your indicator as confirmation. There are some analysis that don't use trade indicators, but you use your indicator to confirm your entry, your trend. Number 3 is your risk management. Very important. Don't go all in because you feel that this setup is I'm so confident that it will buy. Don't be overconfident. This is what kills many traders. Overconfidence that it will buy from here. Nothing can stop it. Then they go all in. Full margin. What destroyed me in 2021? Full margin. 200,000 became 50,000 in few seconds. I can't forget that guy that was giving us that signal. Mike Gold. He call it super margin. That means go all in. That day we went all in. We went all in. I wanted to turn that 200K to something else, like let's say 500,000. And I was so confident in him because his setup used to work. Anytime he say full margin, if you go, you come back home smiling. But that very day, he said full margin. I was on my seat in my dining in Dubai. I went all in. You see what gold did? Gold first, it was a buy signal, but gold was doing pullback. So he first said entry, buy now. So we enter small. Then he now went down a little. He said layer, so we layer. That layer means add more. And that layer, maybe one of these days I'll teach you martingale layer. Layer means add more. That means it will buy, but you have entry here, you have entry here. You make profit from here to here. Then before it goes higher. Market still went down. He said now full margin. So I just went all in. Do you know what gold did that day? Gold first went down. Like, let me draw this thing. Let me show that. I'm not exaggerating. No. This was exactly what happened. Gold didn't break that structure. He only did liquidity grab. So first entry, layer. And that layer should be bigger than the first entry. Then full margin. Gold first went like this. Bam. Account has gone. Then gold did like this. In fact, it kept on going. The candlestick was above my screen. I couldn't wait because the account was already closing by itself. It was already doing stop out, margin call. I'm telling you, that was how, in my very high, like this, you will see it painting red. And I was sick for 3 days. Yeah, I was sick for 3 days. And the people who gave me the money were calling. I didn't pick their call. Until the real person that gave me the money now called me. And I said, don't worry, let's move on. Let's move on. Gone. It's gone. There's nothing we can do. This thing can kill somebody. That's why that risk management is very important. Who took that deep breath? Don't worry, it won't kill you. If God be for you, who can be against you? Risk management. Now, risk management. This is how to approach risk management. There are 2 ways I have adopted in approaching risk management. Number 1, you do the conservative one. You risk 1 to 2% of your capital. This is conservative. But you want aggressive one. It's okay. Aggressive one. Make sure you can trade 10 times. So if I have $1,000, I should be able to trade it 10 times. That means per trade, it's $100. If I lose first one, I go again. If I lose second one, I go again. If I lose third one, I go again. And know by this fourth one, I will come back here. This is the aggressive approach. This is the approach I'm using currently. Why? Because I know that first trade, second trade, third trade, if the fourth one goes, no, that day is a bad day, then I stop trading. This is the aggressive approach, but conservatively. Let's say you just want to build. Like if you are going to start now, just start with this. You are risking $2, $3 per trade, $2, $3 per trade. At least for 1 month you trade. Maybe you've grown the account by $50. That's a starting point. You know, it builds confidence in you. Oh, my setup is working. In the midst of this, you'll be seeing have a lot of up and down, ups and down. Trade, we hit stop loss, you continue. You pick a trade again. The new trade hits take profit, you continue. You understand? You gain 2. The next trade, you lost 1. Next trade, you gain 3. It becomes 5. Then next trade, you lost 1. Then next trade, you lost 1. It went back to 3. Then next trade, you pick, you gain more 5. It becomes 7. That's how you see, you keep going up. Your account too is doing higher, low. Yes, that's what the account will be doing. Not lower, high, low. Not lower, high, lower, low. It must be doing higher, high. So this is healthy. This is healthy. It's normal. Then as your edge grows further, I've done 3 months straight, no single loss. 3 months, Monday to Friday, trading, 3 months. January, February, March, no loss. And it wasn't $13 profit. Sometimes I double the account. Sometimes it's 50%. I've done 3 days. Now, that period was when the regime suits my setup very well. So every execution, profit. Then later, when the regime changed, 1 day loss, 1 day profit. 2 day loss, 3 days profit. 2 day loss, 1 day profit. Until you reset again. Do you understand? So this is the third one, risk management. Very important. Don't go all in that you lose your money in one trade. In one trade is bad. Don't lose your money in one trade. At least be able to say I can trade 10 times. Then discipline. Don't force trade. Don't force trade. Let's trade come your way. If it doesn't work, leave it. Don't say, I must trade. If market is ranging, leave it. If it is moving, place a trade and lock it. Use stop loss or you use pending order. I don't like stop loss. I don't like my account to go down. So what I use is a pending order. So if I'm buying, I place a sell stop. Where I'm supposed to place stop loss, I place a sell stop. So if market goes against me, you open a sell. So I will now be in the middle. Let's say $50 is supposed to minus from my capital. $50 will be hanging on the equity. But my capital is still, let's say 500. But it will be minus 50 on the equity. When the price go up, when it goes down, it remains 50. Then I look for another hedge. I enter. So once I get my profit, I cut the 50 away. Do you understand? Instead of saying I don't like to see losses. It's very difficult for me to. Is it when I place first trade, second trade, and my hedging is too much? That's when I close loss. So you must always have a stop. Not in your mind though. executed on the chart. If not, you'll be saying it will reverse, or you keep shifting your stop losses. In fact, you are not permitted to start with that at all. Your trading must be clean. You have a stop loss, you have a take profit level. It must be clean. Don't build that habit. I saw somebody's account yesterday that he posted on X. He's a friend, a distance friend. He's fond of losing money. He has built an account from 25,000 to 50-something thousand. He was using lot size 2, lot size 2, lot size 2. He capped that amount. Then one trade, he used lot size 20. One trade, wipe him out. That's not trading, that's gambling, that's recklessness. Those are the kind of people that make people perceive trading as something evil, something bad, something dangerous, something you cannot do, something too risky. That 50-something thousand now, using lot size 20, you want to take it because 100 pips of lot size 20 is 20,000. $20,000. So if that trade goes 500 pips, that's like 100K. Yeah, not only double self. You want to magicalize it. And that's a style, but it's not a good style. Why has it remained a style? Because he has built that psychology over time. He has built that psychology over time. He doesn't put stop loss. So anytime money comes, he sees trading as either go or it doesn't go. Not really a UJ or UJ. You know, people have strategy, but the problem is always these two: risk management and discipline. There's no perfect strategy, and there's no strategy that can give you guarantee 70%. If anybody tells you that, it's a lie. Any edge is between 45 to 60. Any edge, any strategy that will work. But remember, I told you to win, you need 40%. So you don't need to be a perfect trader. All you just need to be is a consistent, profitable trader. So I give you $100 today, and between now and Friday, that $100 become 120, 150. Then we take the 50, we share. Within the month, you have turned that 100 to 160. We share again. The next month, we repeat the same thing, and then you can repeat it over and over and over. That's consistent profitability. You too will be happy. Not perfection, because in the midst, you still have trade that hit your stop loss. So that will be all for today. Thank you. So let's face our own business.